The level of US government debt is roughly 130% of GDP. Now, to put that in context, it has been climbing to that level in peacetime. You sell dollars, buy gold. I mean, it's actually as simple as that. But returning to the debt problem, this means that the debt is going to grow to the point where it just basically becomes impossible to fund. And the only way in which it can be funded is for interest rates to rise substantially, and at the same time for the government to cut its spending and to ensure that its budget is in balance. Now, here we are ahead of a presidential election in the presidential election year, and there's absolutely no hope of that. That is for sure. There's probably very little hope of it if what the two main contenders say about their policies come about. There's absolutely no hope of this happening in the next year or two. The dollar has been the world's reserve currency for so long. The assumption in America is everybody needs the dollar. They will keep on buying the dollar. They must keep on buying the dollar because they need it for trade. They need it to go and buy commodities, whatever. But actually, if you look at what's happening, the world is moving away from the dollar, and the people in America are the last to understand this. And I have to say that whenever you get a currency crisis, it is always the foreigners first who actually understand what's going on, because they don't need to hold a foreign currency. They will be the first to sell it. And then, at some later stage, the domestic users of the currency begin to realize that it's the currency going down, not prices rising. And that brings me on to another element of this, and that is inflation. The idea of inflation, as put about by the establishment and by the press, is rising prices which can be controlled. I mean, the latest one is, Ms. Harris saying that, price gouging and all the rest of it, and we will stop it. So we'll do what Diocletian did. Not that she's ever heard of Diocletian, I'm sure. And that is, put price controls on. It doesn't work. It never works. But the point about this is that the driver of inflation is actually budget deficit and consumer borrowing to fund consumption. Those are the things that drive up prices, or, if you like, put the other way around and more accurately, drive down the purchasing power of the currency. And that is exactly the situation we still have. And it's going to get worse, particularly from the government end. And when you look at consumer behavior, savings in America have collapsed. They've gone negative. So, this is a disaster for the economy, where you have got a combination of a debt problem. You have got, a nasty recession, potentially a nasty recession, and I would actually call it a slump in the early stages of development. And on top of that, rising prices or a loss of purchasing power in the currency. This is the worst possible stagflationary scenario. Now, we had this back in 1976. And in 1975, actually, sterling collapsed against the dollar. It went down to around about, I think, $1.10, roughly where it got to in recent history, maybe even a bit lower than that. America came in and loaned us money in order to save the currency, which was fine. But obviously the condition was that the IMF come in, the IMF repays America, the IMF puts in controls, requirements, and all the rest of it, which takes it away from the politicians. And this is exactly what happened. The IMF said, right, you've got to balance your budget. Don't care. You raise your taxes, however you do it, but you've got to have a balanced budget. And in order to fund the situation, interest rates rose to the point where we had 3 bond issues of 15, 15.25, and 15.5%. Now, the problem that America faces is that there isn't someone like the IMF to come along and rescue them. I mean, it's just not there, because apart from anything else, you own the IMF. I mean, figuratively speaking, the IMF might account in SDRs, but basically it's a dollar-based organization, and it's not in a position to rescue the dollar. So you've got you have a situation which is worse than we had potentially in 1976. When we were funding at 15.5% coupons. Just imagine what that does to the US economy.
For decades, the US dollar has reigned supreme as the world's reserve currency. Many Americans still believe that the dollar's dominance is permanent. operating under the assumption that other countries will always need to hold dollars for trade, particularly for commodities like oil. This belief has created a sense of complacency, where Americans assume that the dollar will always be in demand, allowing the U.S. to maintain economic stability even as it amasses massive levels of debt. However, Alasdair Macleod points out that the reality is shifting and the world is gradually moving away from its reliance on the U.S. dollar. What's especially concerning is that it's the foreign holders of the dollar who are recognizing this first. Foreign governments and investors are no longer as dependent on the dollar for trade as they once were, and they are starting to diversify their reserves into other currencies and assets, particularly gold and silver. This is a critical point because when foreign entities lose confidence in a currency, it usually triggers a sell-off. In the case of the US dollar, such a sell-off could spiral into a full-blown currency crisis. Macleod highlights that this is a typical pattern in currency crises. It is always the foreigners who act first. They don't need to hold a foreign currency like the dollar the way domestic users do, so they are quicker to sell when they see signs of trouble. This dynamic played out in many historical currency crises, and the U.S. is not immune to it. Foreign holders of U.S. debt are already cutting back on their purchases of U.S. treasuries. Countries like China and Japan, historically major buyers of U.S. government debt, are no longer purchasing at the same levels. This is a clear warning sign that the global demand for dollars is waning, and with it, the support for the U.S. economy. As foreign holders reduce their dollar exposure, domestic users of the dollar will eventually wake up to the fact that it's not prices that are rising, but rather the dollar is losing purchasing power. This brings us to the topic of inflation, a concept that is often misunderstood. The establishment and mainstream media portray inflation as simply rising prices, but as Macleod emphasizes, inflation is better understood as the erosion of a currency's value. When a currency loses purchasing power, it takes more of that currency to buy the same goods and services, which appears as rising prices. In the U.S., and politicians like Kamala Harris have responded to inflation by blaming it on corporate price gouging. This kind of rhetoric misses the point entirely. Inflation is not caused by corporations raising prices. It is caused by government budget deficits and excessive borrowing, which flood the economy with more currency, driving down its value. When the government spends more than it collects in taxes, it has to borrow money to cover the deficit. This borrowing, particularly when it is used to fund consumption rather than productive investment, reduces the value of the currency. In the U.S., the situation is particularly dire because savings have collapsed and gone negative, meaning that Americans are borrowing more than they are saving. This combination of rising debt, slowing economic growth, and declining savings is a perfect storm for a currency crisis. Macleod compares the current situation to the UK in the mid-1970s, when the British pound collapsed against the dollar. Back then, the International Monetary Fund stepped in to provide a bailout, but the US won't have the luxury of an IMF rescue. The IMF is a dollar-based organization, and there is no external entity that can save the US from its own currency crisis. In fact, the US essentially owns the IMF, so there is no one to bail out the dollar.
The level of US government debt is roughly 130% of GDP. Now, to put that in context, it has been climbing to that level in peacetime. If you look at World War II, the most it ever got up to was 119%. In other words, the debt today is greater than it was with the war economy in 1946. Now, that is extremely important. The reason it's a debt trap occurs when the growth in your income, and it doesn't matter whether it's a government or individuals or a company, when the growth of income is less than the growth of debt. And obviously, the growth of debt includes the interest which is being rolled up. Now, that is now the situation again. We had this during the great financial crisis, when Lehman went bust. We had it in COVID, obviously. And we were just sort of getting our heads above water, or at least America was getting its head above water in terms of the debt trap, before we then started going down into that situation where income was not exceeding, if you like, the growth in debt. The growth in income was not exceeding the growth in debt. So, and the reason for that basically is you've got a slowdown in the US economy. You've also got inflation. And one way and another, the foreigners aren't really buying your debt. I mean, we've got China is not buying for her reasons, and nor is Japan. So the foreign involvement in acquiring debt, while since, I suppose, the Lehman crisis, their holdings in US treasuries have doubled. In fact, the percentage of publicly held debt in foreign ownership has actually fallen from just under 50% to just under 30%. So they're just not participating in the growth of your debt. We're now talking about a situation where foreigners are going to get less, if you like, in return for lending money to the US government because interest rates will be lowered. And this was clearly signaled at Jackson Hole by Jay Powell. And I think that is a huge, huge mistake. And already we can see the effect on the dollar. The dollar has entered on a chart, something called the death cross, where the price is below the 55-day moving average, and the 55-day moving average is crossed below the 250-day moving average. All these, the price and average is all declining. That is a death cross. It's a very, very bearish signal. And you can understand why. And so, I mean, the other side of it, of course, is gold. And this is why gold is going so well. I mean, under the gold price, you have a golden cross, which is the reverse of the death cross. So, you sell dollars, buy gold. I mean, it's actually as simple as that. But returning to the debt problem, this means that the debt is going to grow to the point where it just basically becomes impossible to fund. And the only way in which it can be funded is for interest rates to rise substantially, and at the same time for the government to cut its spending and to ensure that its budget is in balance. Now, here we are ahead of a presidential election in the presidential election year, and there's absolutely no hope of that. That is for sure. There's probably very little hope of it if what the two main contenders say about their policies come about. There's absolutely no hope of this happening in the next year or two.
This debt trap was temporarily papered over by the Federal Reserve's quantitative easing, QE programs, and ultra-low interest rates. But these measures were only ever a temporary fix. Now that inflation is rising, the Fed is being forced to tighten monetary policy, and the debt trap is becoming more apparent. The U.S. economy is slowing, inflation is accelerating, and foreigners are no longer as interested in buying U.S. debt. Foreign ownership of U.S. treasuries has fallen from nearly 50% to under 30%, indicating that other nations are diversifying away from the dollar. The implications of this shift are profound. As Macleod points out, the U.S. is now facing the prospect of rising interest rates at a time when it can least afford them. Higher interest rates will make it more expensive for the government to service its debt, pushing the U.S. deeper into its debt trap. At the same time, cutting government spending to balance the budget is politically unpalatable, especially with a presidential election approaching. Neither of the major candidates is likely to propose the kind of deep spending cuts or tax hikes that would be necessary to stabilize the debt. Instead, the U.S. government is more likely to continue running large deficits, which will further erode the value of the dollar. This leaves the U.S. with only one real option: inflation. By devaluing the dollar, the government can reduce the real burden of its debt, making it easier to pay off in nominal terms. However, this will come at the cost of eroding the purchasing power of American citizens. In other words, inflation will act as a stealth tax, gradually transferring wealth from savers and wage earners to the government. In this environment, gold and silver are the ultimate safe havens. As Macleod points out, gold is already performing well in the face of rising inflation and currency devaluation. Central banks around the world are accumulating gold at an unprecedented rate, recognizing that it is a hedge against the devaluation of fiat currencies. In the first half of 2023 alone, central banks purchased record amounts of gold, signaling that they are preparing for a global financial shift. One of the key reasons gold and silver are so valuable in times of crisis is that they are not subject to the same risks as fiat currencies. Fiat currencies, like the US dollar, can be devalued at will by central banks. Gold and silver, on the other hand, are tangible assets with intrinsic value. They have been used as stores of wealth for thousands of years and cannot be printed or artificially manipulated in the same way as paper money. Macleod emphasizes that gold and silver are not just investments, they are forms of savings. In a world where fiat currencies are rapidly losing value, holding gold and silver is a way to preserve purchasing power. Even if the nominal price of gold or silver fluctuates, the real value of these metals remains stable over time. In fact, as inflation erodes the value of paper currencies, the price of gold and silver is likely to rise significantly. Gold and silver are also immune to counterparty risk. When you hold physical gold or silver, you are not dependent on a financial institution or government to honor a contract. In contrast, when you hold fiat currency, your wealth is subject to the decisions of central banks and governments, which can devalue the currency at any time. This makes gold and silver the ultimate hedge against not only inflation, but also financial instability. Another key point Macleod raises is that the world is already moving away from the US dollar and toward gold. Countries like China and Russia are leading this shift. Both nations have been accumulating gold reserves at a rapid pace, positioning themselves for a future where the dollar is no longer the dominant global currency. China, for example, is the largest producer of gold in the world and has been steadily increasing its gold reserves. Russia, too, has been a major buyer of gold, and both countries have been reducing their reliance on the US dollar in international trade. This trend is part of a broader effort by the BRICS nations, Brazil, Russia, India, China, and South Africa, to create a new global financial system that is less dependent on the dollar. The move away from the dollar and toward gold is not just a trend among central banks. Private investors around the world are also increasing their allocations to gold and silver as they seek to protect their wealth from inflation and currency devaluation. In the US, however, public participation in the gold and silver markets remains relatively low. Most Americans are still holding their wealth in fiat currencies, unaware of the risks they face. Alasdair Macleod's analysis paints a bleak picture of the future of the US dollar and the global financial system. The US is trapped in a cycle of rising debt, slowing growth, and declining foreign demand for its currency. Inflation is accelerating, and the government is unlikely to take the necessary steps to address the debt problem before it spirals out of control. For investors and savers, the message is clear. Now is the time to act. Gold and silver are the ultimate hedges against currency devaluation and financial instability. They offer protection in an environment where fiat currencies are losing value and central banks are printing money at unprecedented rates. As Macleod emphasizes, gold and silver are not just investments, they are forms of savings. They preserve purchasing power over time and are immune to the risks associated with fiat currencies and counterparty obligations. In times of crisis, gold and silver have historically outperformed other assets, making them the safest stores of value. The world is moving away from the US dollar, and those who fail to recognize this shift will be left holding a devalued currency. By accumulating gold and silver now, investors can protect their wealth and prepare for the inevitable changes in the global financial system.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.